Welcome to Talk Tickers. This is the deep dive where we strip down the earnings calls and the raw data to find the signal for experienced investors.
And I'm here to help you parse that noise. It is Monday, January 26, 2026.
And we are jumping right into the mortgage REIT sector. Dynex Capital, that's ticker DX, dropped their Q4 2025 results this morning.
And it is quite a report.
I feel like two people could look at this and see completely opposite things. It's a real Rorschach test for investors.
It's the classic split screen quarter. If you're an income investor, focus on that monthly dividend, you're probably not thrilled.
But if you're a total return person looking at the underlying value of the business,
you're having a very, very good day.
So let's start with that market reaction. Mm-hmm. It was, hesitant?
Hesitant is the perfect word. The stock closed at $14.54, down about 0.5%, basically flat.
So the market is weighing this big income miss against something else.
Exactly. Let's talk about the miss first. The number everyone watches is ED earnings available for distribution.
That's the cash flow that covers the dividend.
The holy grail for these companies. And the street was looking for about $0.27 share.
And they came in at
the 22 cents, a 5-cent miss. For a company that pays its dividend monthly, that's the kind of thing that makes people nervous.
It immediately brings up questions about the dividend's safety.
Right.
That's the third rail you don't touch in this sector.
You do not, but that's just one screen. While that was happening, the value of their portfolio absolutely soared.
Okay, so this is the other side of the coin.
This is the beat. Book value per share jumped to $13.45.
Wow. Up from what?
It was $12.67 in September. So when you add that gain to the dividends they paid out, you get a total economic return for just the fourth quarter of 10.2%.
Hey, hold on. Say that again. 10% in 3 months.
Over 40% annualized. So you see the tension. The cash flow number looks weak, but the economic engine is just printing money.
So how do we bridge that gap? I mean, if the machine is running that hot, why did the distributable cash fall short?
It's a paradox, right? The miss was actually caused by how successful the quarter was.
How does that work?
It all comes down to expenses. Specifically, performance-related compensation accruals.
The traders got their bonuses.
They crushed their bonuses. The full-year economic return for 2025 was almost 22%. That triggered a huge bonus accrual, which hits the expense line and drags down that EAD number.
So shareholders are paying for the performance they just got.
In the short term, yeah. It's what they call a high-class problem. Management was pretty clear. They expect G&A expenses to run around 2% of capital for a while.
They're investing?
Investing in people, in tech. They're scaling up. And, they are scaling aggressively.
That word scaling was everywhere in the call. I was looking at their capital raising. It's just relentless.
It's a complete transformation. They raised $1.5 billion in equity over the last 13 months.
And the portfolio size?
It doubled in 2025. Doubled. From under $10 billion to almost 20. And they're already pushing $22 billion as of this month.
That is just massive growth. Is that just empire building, or is there a real strategic reason to get that big that fast?
Oh, there's a very specific reason. And it's all about surviving in the age of passive investing.
The age of the ETF.
Exactly. Management was super explicit about this. If you're a small cap REIT, you're basically invisible to the big index funds, the algorithms that drive all the volume.
You have to be big enough for the machines to see you?
You have to be. By pushing their market cap up towards $3 billion, they basically force the indices to buy their stock.
Which improves liquidity and, in theory, lowers their cost of capital.
That's the play. It's a financial engineering strategy on top of the mortgage strategy.
Okay, but let's zoom out to that mortgage strategy, because the world they're trading in is also changing, right?
Yeah.
The CEO and CIO were talking about a regime shift.
Yeah, and that's a heavy term.
Usually means something broke.
In this case, they think it means something's been fixed, or at least stabilized. They're arguing the wild volatility of the last few years is basically over.
And we're moving from dislocation to what?
To policy support.
Which is code for the government.
The government is back, specifically the administration and the FHFA. The big catalyst was the decision to let Fannie Mae and Freddie Mac increase their retained portfolios by $200 billion.
Okay, let's just decode that. For years, the GSEs were shrinking, right? Stepping back to let private capital take over.
Correct. The narrative was shrink the government footprint, and now complete reversal. The government is telling the GSEs to start buying again.
They're putting a whale back in the ocean to soak up supply.
And management's argument is that this removes the tail risk.
The nightmare scenario where spreads blow out and everybody gets a margin call.
That risk is much, much lower now. You have a buyer of last resort with a $200 billion checkbook. It's the return of the native balance sheet.
It's a safety net. But if the risk goes down, the reward usually goes down too. Did they talk about that?
They did. And this is a really crucial pivot. They stopped calling this a generational opportunity. That language is gone.
What are they calling it now?
A normalized market. Spreads have tightened. A lot. We're talking 150 to 300 basis points tighter, depending on the coupon.
So the easy money's been made. The shooting fish in a barrel phase is done.
It's over. Now it's back to the grind.
So if you can't just own the market anymore, the beta trade is gone. How do they keep posting numbers like that 10% quarter? Where does the alpha come from?
It all shifts to security selection. You have to be a stock picker, but for bonds. And right now, their absolute obsession is prepayment risk.
The risk that homeowners refinance their mortgages early.
Right. You get your money back when you least want it, when you have to reinvest at a worse yield.
But it's worse now, isn't it?
It's so much worse. And it's because of technology. Think about refinancing 20 years ago. It was a pain. You had to call a broker, fax documents. There was friction.
Now you just get a push notification on your phone. Click here to save $200 a month.
Exactly. The originators have automated it. They can target people with surgical precision. And that efficiency has killed the old concept of burnout.
Burnout being the idea that eventually everyone who's going to refi has already done it.
And you could count on a certain percentage of people just being too lazy. That inefficiency is gone. Technology made it better for the homeowner, but way more dangerous for the bondholder.
So Dynex is basically fighting an algorithm.
They are. They have to hunt for very specific loan pools, mostly in the 5.5% coupon range, that are protected from that one-click refi risk.
What are they looking for?
Things like low loan balances, investment properties, stuff that's just harder to automate. They're looking for stickiness in a very slippery market.
And they hedge all this. I saw them use the phrase, prepare, not predict.
It sounds like a bumper sticker, but it's a real strategy. They're not betting on rates going to 3% or 6%. They're building a portfolio to survive what they call a flat fat tail distribution.
Flat fat tail. Sounds like an insult.
It just means anything can happen. It's a statistical term meaning that extreme outcomes are more likely than you'd think. So they're using options to protect against a huge range of possibilities, not betting on just one.
Okay, so let's bring this all back for the listener.
Yeah.
You have a company scaling up to play the index game, dealing with an expense miss, but now operating in a market they say is backstopped by the government.
It's a government policy trade now. If you own DX, you're betting the administration views housing affordability as a non-negotiable issue.
The Fed put for mortgages.
I'd call it the government put.
Yeah.
And if that's true, the downside volatility should be way lower than it was a couple of years ago. You get a steadier return. The crash risk is, in theory, off the table.
But there's always a catch. What are the risks here?
Execution is the big one. They're sitting on $1.4 billion in cash and liquidity. If they can't deploy that fast enough while spreads are tightening, they get cash drag.
Money sitting on the sidelines, earning nothing.
While you still have to pay the dividend. And then there's the macro risk, politics. The whole thesis depends on the government staying in the game. What happens if inflation really, truly spikes?
The government's hands are tied. They can't just print money to buy mortgages if that's what's causing the inflation.
Exactly. The backstop could vanish.
Yeah.
And that tail risk comes roaring right back.
Okay, that feels like a good summary. Now let's shift gears a bit.
I think I know where this is going.
It's time for the segment where we take all this, toss the safety manual out the window, and get a little speculative.
So the disclaimer.
Oh, absolutely. This is purely for entertainment. This is not financial advice. Do not bet the farm on this. We are just talking here.
But if you were pitching a high-risk trade idea based on this call, what's the pitch?
I'm calling it the bureaucracy levered long.
Okay. Bureaucracy and long don't usually go together for a profit. I'm intrigued.
The core assumption is what Dynex management said. The government has sold a put option on the mortgage market. They cannot let housing crash. That's our starting point.
Okay, reasonable assumption.
So, step one, you go long the basket of these agency MREITs. Heavy on Dynex for the convexity, maybe some others. You want the assets that get that government backstop.
Standard stuff so far. Just a bullish call on the sector.
Here's the twist. It's how you finance it. You finance the trade by selling out-of-the-money puts on the 10-year Treasury.
Whoa. So you're selling insurance on Treasury bonds. You're betting that Treasury prices won't crash.
Which means I'm betting yields won't spike. because I'm betting the administration is trapped. They can't let the 10-year yield run wild because that would kill housing instantly. So they'll do whatever it takes to cap rates.
So you collect the premium from selling those treasury puts.
And I use that cash to buy upside calls on the M-REITs. I'm leveraging the government's fear on both ends of the trade.
Wow. Walk me through that one more time.
I'm betting they keep mortgage spreads tight, which is good for the M's, and I'm betting they keep treasury rates capped, which is good for my short puts. It is an all-in bet that the government will choose printing money over volatility every single time.
That is outrageous. And also terrifyingly plausible. You are front-running the Fed and the Treasury at the same time.
That's the trade. But what kills it? What's the bullet with my name on it?
The steamroller. It's inflation.
Explain.
If inflation really rips and the bond market revolts, the government loses control. Their hands are tied. Rates have to go up.
And the trade implodes.
Instantly. Your short puts get exercised, forcing you to buy crashing treasury bonds with your own money, and at the same time, your MREIT calls expire worthless as the sector gets vaporized.
Total wipeout.
You're picking up pennies in front of a steamroller, betting the driver has promised not to hit the gas. It's pure asymmetry.
High risk, high reward. Hypothetically, of course.
It is a very creative expression of the regime shift thesis, I'll give you that.
Well, on that cheerful note, let's wrap up our deep dive on Dynex Capital, a company that's getting huge, banking on government support and telling us the wild times are over.
They're saying we're back to normal, but I want to leave our listeners with just one final thought.
Go for it.
Management is betting the house on a return to normal. But you look at the world. $35 trillion in national debt, shifting demographics, geopolitical tension everywhere.
Does normal even exist anymore?
That's the question. Or is volatility the only normal we have left? Something to think about before you lever up on the promise of stability.
The question of the decade. Thanks for listening to Talk Tickers. As always, do your own diligence. We'll catch you on the next deep dive.
Good luck out there.